What if you could tilt the odds so your bad outcomes are survivable and your good outcomes are life-changing? That's the Stoic way to risk, not avoid it, but engineer it. Shape decisions so the downside can't wreck you and the upside can surprise you. Today, we're fusing ancient calm with modern money to answer a single question. How do you take smart bets at work, in business, or in markets without gambling your future? Start with control. You can't command the ocean, but you can choose your boat, route, and weather window. In money terms, you don't control returns. You control contributions, costs, sizing, and time. You don't control headlines. You control your inputs, your rules, and your reactions. Most people think risk versus reward is a slider. Slide one way for safety, the other for return. Smart investors don't slide. They sculpt. Small downside, big potential upside. Make your worst day inexpensive and your best day possible. Seneca gives us the mindset compass. Luck is what happens when preparation meets opportunity. Your preparation is your rules. The world supplies the noise. Buffett gives us the money compass. Risk comes from not knowing what you're doing. Risk isn't just volatility. It's ignorance, leverage, and bills due tomorrow. Shrink those, and what looked risky becomes rational. The Stoic Smart Bet Framework. You can run this on anything, from buying a stock to pitching your boss. 5 steps: define, downside, design, decide, debrief. 1. Define. What's the engine? How does time or money turn into more? If you can't explain it to a sharp teenager in plain English, you're guessing. 2. Downside. List the 3 most expensive ways this could fail. Add a guardrail for each. Out of cash, cap fixed costs plus build buffer. Reputation hit, size small plus time box the project. Emotional damage, set clear expectations. Your first job isn't to maximize reward. It's to make failure survivable. 3. Design. Shape the bet for asymmetry. Position size. Entry rule. Exit rule tied to facts. Optionality. Ways it could go better than expected. 4. Decide. Decide by rule, not mood. If the facts match your entry rule, take a small step. If not, wait, no matter how loud the room gets. 5. Debrief. After any result, ask, what did this reveal about my process, size, or assumptions? You're not aiming for perfect bets, just becoming a better. Real-world applications. Investing. Think like a barbell. Boring base plus optional upside. Base, broad index funds. Low fee, global. Boring, powerful. Sleeve, 10 to 20% for high-quality businesses you understand. Rules, what's the engine? What would prove me wrong? Size to your sleep. Add in 0.5% units. Exit only on broken facts. 4 higher-risk plays, startups, crypto, use a sandbox. Cap exposure, small enough that a total loss is a shrug. There's no glory in never touch anything spicy, but zero wisdom in letting it burn your kitchen down. Career. Smart career bets are small cost, big upside. Define, I will automate X and save 10 hours a week. Downside, time box to 6 weeks. Manager informed, measured by one number. Upside, documented win. Visible impact raise request backed by data. Pitch on Monday. Debrief regardless. Skill and visibility always pay. Small business. The bet, minimum viable offer to prove or kill demand. Define, one offer, one page, one outcome. Downside, $500 and 30 hours max kill date on calendar. Design, pre-sell if possible. Reuse tools you already own. Decide, launch in 2 weeks. Debrief, what worked, what didn't. Roll the learnings into version 2. A failed offer that teaches is tuition, not failure. The math without the math. Expected value equals probability of win times gain, probability of loss times cost. But life rarely gives clean probabilities. So do 2 Stoic things. Shrink the downside with sizing plus stop rules. Widen the upside using skills, distribution, or design, not leverage. Ask, if this works, what permanent upgrade do I keep? If it fails, what reusable asset do I still own? A new system, a case study, a contact, a lesson. That's asymmetric payoff. Heads I win, tails I don't lose much. Monish Prabrai. That's your filter. Simple tools to run it. Risk card. Draw 4 boxes. Cost to try. Cost to fail. Floor outcome. Ceiling outcome. If the first 2 are small and the last 2 are meaningful, go. If not, redesign or pass. Risk budget. Pick an amount of time or money you'll spend on experiments per quarter. When it's gone, pause. No chasing. Next quarter gets new bets. 2 clocks. Results clock measures outcomes. Process clock measures consistency. Judge yourself by the process clock. That's how you stay calm when results are noisy. Red team. Before you commit, argue against yourself. If this fails, it fails because X. Install 1 guardrail for each point. You just turned anxiety into strategy. Owner's exit rules. Write them in plain English. If 2 quarters break metric X, I exit. If a position grows above 10%, I trim at review. Rules written in calm protect you from panic. Protect the foundation. 1 month of bills and checking. 3 to 6 months in liquid reserves. Cap fixed costs. Ensure the big stuff. Money outside the market protects what's inside. It also protects your creativity. Debunking 2 risk myths. Myth 1. High reward requires high risk. Not always. Often, high reward comes from high patience and low friction. Index investing proves that. Myth 2. Big swings are the only way to catch up. Big swings cause big setbacks when mistimed. Small, smart bet stack. That's compounding. Quick note on leverage. Leverage isn't always bad, but if it can force you to sell on a bad day, it owns you. Only use it where cash flows are predictable, terms are clean. You could survive a 50% drop without panic selling. When in doubt, pass. Optionality beats obligation. Curate your feed. Your inputs shape your instincts. If your feed is full of crash clips and moon coins, your reactions will mirror that. Instead, follow builders. Read a page a week of shareholder letters or investor memoirs. Replace 20 minutes of doom scroll with 2 minutes of clarity. Come in, come out. 60-second risk drill. Breathe. 426. Name the bet. Ask, what's the engine? What's my max loss? What asset do I keep if it fails? If the answers are foggy, you're not ready. If they're clear and the downside is capped, start tiny. Then put down the phone and move your body. Movement resets mood. The Stoic Smart Bet Sprint. Day 1, draw your risk card. If green, take the smallest first step. Day 2, write exit rules for what you own. Day 3, create a sandbox budget, time or dollars. Add kill dates. Day 4, run a red team on your next idea. Install guardrails. Day 5, set 2 strategy edit dates, 6 months apart. Day 6, cut 1 recurring cost. Redirect it to your base investment. Day 7, make 1 asymmetric career bet. Pitch a project that saves or earns. Closing creed. Say it out loud. I control process, sizing, costs, and time. I cap the downside and design for upside. I decide by rule, not mood. I sell on broken facts, not scary prices. I play long games with long people. I let preparation meet opportunity until luck looks inevitable. If this helped you see risk with clearer eyes, subscribe. Here, we blend ancient wisdom and modern systems, so your next bet is bold, not blind. Start small. Protect the floor. Let time magnify the ceiling. That's the Stoic way.